Hey, what's going on, traders? This is Chris at VerrilloTrading. Today's video is going to be called Why I Trade Futures. I'm going to try and give you all of the points that I could come up with regarding why I choose to trade futures personally over other asset classes that I've traded in the past, like stocks or stock options. And I still do trade stocks, but sort of differently. Regarding futures trading, they're more geared towards short-term speculators or risk management on a bigger picture if you need to do that. So I want to explain to you the pros and cons with futures trading here today, why I choose to trade them, but I'm also going to explain to you some of the negative sides to futures trading as well, certain things that I did not know when I started trading them just around 2 years ago. And I've been trading for over 3 years, but futures is about 2 years. So let's get to it. I want to remind you guys that this video is for educational purposes only. It's not a recommendation to trade. In fact, the majority of people who try trading are not going to be able to stick with it for the long run and really know what they should be doing in the long run so that they can be consistent, manage their risk, and be profitable consistently. So I'm not recommending you to trade at all. In fact, I would say don't bother. But if you are interested in trading and you want to learn more about futures trading, then this video might be able to give you some information because I've been trading them for quite some time and I've learned a lot of things. So let's get to it. And remember to hit the like button and subscribe and click on the links in the description if you want to support the channel. All right. The first reason why I trade futures is regarding better liquidity and easier to track the liquidity in these markets. Now, this is not always true, by the way, because the liquidity comes and goes into the futures market, and this is a pro and a con regarding futures. It's that the liquidity really changes, and I think this applies to all markets, but I think it is pretty exaggerated some days. If you look at, for example, the S&P 500 E-mini futures or Treasury futures before a news announcement, and you'll see how the liquidity changes itself. And it just so happens that as at the time I'm recording this, there's some considerable volatility, which we have not seen almost all day, and now the volatility is here. Well, that's fine. I just started recording a video, so no big deal. So let me give you an example regarding dollar volume being traded on some of these futures contracts. So I'm going to open up my Interactive Brokers platform on the other screen here, and I'll bring you guys over to that screen. And take a look right here. We're going to look at the S&P 500 E-mini futures, which would be ES right here, March contract. Today's traded dollar volume, and this data is delayed by 10 minutes, but it doesn't matter. You can see that it's $170 billion that is traded in notional dollar volume that is transacted in the S&P 500 futures, ES. Okay. Now, if we flip over to the spiders, which would be the SPY, and we look at how much dollar volume is traded there, we can see 18 billion. So there is a lot less volume going through in the spiders versus the actual ES. Now, this changes, right? If we look at the NASDAQ, you'll see something maybe different, right? So for example, the triple Qs ETF is traded almost 11 billion today, and the NASDAQ futures have traded 102 billion. So it's still only around 10% of the volume going through on the futures. Now, in the last couple of years, the Chicago Mercantile Exchange came out with the micros, which are the micro E-mini equity index futures, like the MES or the MNQ or the M2K, which would be for the Russell 2000. And we can see that there's a lot of dollar volume trading there as well. For example, the micro NASDAQ futures today only has traded close to $22 billion in dollar volume right there, and 733,000 contracts. So as you can see here, guys, there's a lot of dollar volume trading in the futures market. Now, that does not mean that the futures is very reliable and that it's going to be the most reliable thing to watch in order to track what these indexes are supposed to be doing. Because at times, many of you will notice that if you take a look at the liquidity on the order book, for example, in the S&P 500 futures, today is an example of a day where the liquidity is a little bit higher because the volatility has been lower, so more traders are willing to place bids and offers, and you can see here on average we have between 40 and 80 contracts displayed at every bid and offer here. On a day where the volatility is higher, you might be lucky if you see 10 or 20 at every price point, and the market will be moving a lot more during that time because there's not enough traders willing to participate at the close prices that are going to be keeping the price contained. And there's basically too much volume going through in the overall market because remember, this is an index of stocks here, the ES or S&P 500 index. And there's 500 stocks. So basically when you're trading in the ES futures, you're trading with traders who are doing business in over 500 stocks at the same time. So that's what can make it sometimes tricky to track the dollar volume. So what I wanted to explain to you guys there is that one good thing about futures is that they have a lot of liquidity. Sometimes they don't, but most of the time they have very good liquidity. However, not enough liquidity sometimes to keep up with the actual amount of dollar volume being traded. Now, if we flip over to a market where the opposite would be true, where I would say the liquidity is good on the order book, but there's just not enough volume going through. And that would be this contract right here, which is the Japanese yen against the US dollar futures, again, trading on Chicago. And you can see here that there's a good amount of liquidity at each price, but there's just not a lot of volume going through. This is a Forex pair, and I can guarantee you that if I do switch over to the Forex spot symbol, we're going to see a lot more volume going through there, because Forex is really not centralized, and there's just so many different exchanges and banks that have their own liquidity pools that are transacting in this Forex pair, and it's not being reflected in the volume that's transacting in the futures contract. So this would be an example of a contract where the liquidity is good, but the volume being traded is not there. So the volume here is much less reliable than it would be on the S&P 500 futures or on bonds, for example, okay? So when you're trading futures, you got to understand that they are derivative products and that their liquidity sometimes is just not enough for what's actually going through. So you'll often see bids and offers just being added and pulled, and that's what's moving the price instead of actual volume being traded. Okay, so the next reason why I trade futures is lower trading fees and lower capital requirement. Now, this is a little complex, guys, and I'm not just going to say that you're going to have lower trading fees, because it's going to depend on your broker and the agreement you have with your broker. There's a lot of different futures brokers out there. I use Iron Beam, and I would recommend them if you're looking to have a more personalized experience. Guys, just remember, futures trading, it doesn't matter who your broker is. You know, you're engaging in the same marketplace. Everybody's trading on the Chicago Mercantile Exchange, and your orders go directly there. At the end of the day, it's up to you to do your own homework. But I will say that I like Iron Beam because they have very good customer service, and you'll have a more personalized experience, rather than if you go with a bigger broker that is less likely to cater to your needs as a small trader, for example. So lower trading fees, it depends, and lower capital requirements, absolutely true. So futures trading has the lowest capital requirement out there compared to other asset classes. And this is because many brokers will allow you intraday margins. What an intraday margin is the broker's allowing you to trade a contract or put on a position in a contract. As long as you close the position before the exchange closes, you will be allowed to trade these contracts for a very low amount of capital, sometimes even $100 or less in your account to trade one contract on big contracts. For example, we can look at the 5-year treasuries or the 10-year treasuries. Some brokers offer you an intraday margin of about $100 or $150 to trade that, when the notional size of that contract, for example, the ZN or the ZF, is $100,000. So every time you buy one or sell one, you are controlling $100,000 worth of treasury bonds. Now, normally speculative traders, they think of it in terms of what the actual tick increment of the market is. So for example, in the 5-year treasury, one tick is worth $7.81 in US dollars. So from 10 and a quarter 30 seconds to 10 and a half 30 seconds, that's $7.81. So if I bought 10 and a quarter and I sold 10 and a half, I made $7.81, and then I subtract my round turn commission from that. Okay, so normally traders will think of it in terms of that. They're not thinking of it in terms of I'm controlling $100,000 and I only need $100 to trade it. But you still need to understand that the day trade margins have an enormous amount of leverage, and it needs to be used responsibly. And I have another video on that called Position Sizing for Day Traders, and I think you guys should go watch it. If you're new to trading with intraday margins, check that video out, please. Because if you don't understand some of those basic principles, you are basically going to be a sucker and you're going to blow your account very fast. So don't be that guy. I've been that guy before, and I'm just trying to help out newer traders. Okay, the next reason why I believe futures are great instruments to trade are that there are many different participants that are involved in these markets. And similar to stocks, futures also have a lot of people watching them on a daily basis. We have high frequency traders that work for the exchange that are doing market making or trading for one tick at a time. We have retail traders who are trading mostly the S&P E-mini futures and the NASDAQ and crude oil. We have pension funds, hedgers, and all kinds of different institutions that do business in these futures products. In a way, it creates a lot of chaos. In another way, it creates opportunity because there's always business that's being done. So if you have a way of doing business that works for you, that you've identified an edge in the marketplace, there's a better probability you're going to be able to make quick entries and exits or precise entries and exits into the marketplace and manage your risk better because there's just an overall a lot amount of volume going through in the marketplace. So I'm speaking mostly for the S&P futures. You know, we can talk about treasuries as well, but treasuries are a little different. Sometimes when the stock market's slow, treasuries just get way too slow. When the stock market is too volatile, then treasuries kind of get into a bit of a sweet spot, but it depends, right? It's never perfect. The liquidity and the amount of volume going through, it changes from day to day, guys, and you really need to adapt to that. So a lot of participants, if we look at a market like crude oil or NASDAQ or S&P futures or 10-year treasury, right? So these are big markets. A lot of traders look at them, retail traders, institutions, and all of that. And that's what makes them good trading vehicles. As long as there's good volume going through, you're going to have a good opportunity of making money. Now, the next thing I just wanted to touch on regarding futures markets and why I believe that they're better to trade than stocks is regarding the matching engine on the exchange. Now, I'm not going to go into so much detail about this, but I think that you guys should educate yourself about this if you are trading futures. So there's something called FIFO, or first in, first out. Most CME traded contracts operate with the FIFO matching engine. Now, there are certain priorities that are given to larger order sizes or clearing members or designated market makers that also work for the exchange. There's, of course, priority given to them regarding the Q position. But at the end of the day, the FIFO matching engine is still there. So theoretically, if I place a buy order on the best bid here, and when there are traders that come in after and place buy orders after I've placed mine, theoretically, my order should be first. But again, it's not as simple as that. So I think you guys should educate yourselves there regarding the priority of certain orders. I do not know if stocks operate with a FIFO matching engine similar to the way certain CME products are traded. So I could not comment on that. But if you guys do know, then please write it in the comments down below. Okay, so that's something very important about futures trading that I think is important to know. Now, the next reason why I trade futures is regarding the trade tools that are available. And that's going to bring us into one of the cons. And again, I've kind of been going through pros and cons as you hear me discussing this, but the next point is regarding better trade tools. Okay, now this is debatable. I want to tell you about a trade platform called Sierra Chart. This trading platform has existed since the 90s, and they originally started as exclusively a futures trading platform. Only recently, they have started to support stock market data feeds, and by recently, I mean probably in the last 10 years or 5 years. So they support data feeds for a variety of asset classes, but they started off as a futures trading platform. Now, in the time that they started, there was also other platforms that were on the market, like Market Delta, where they came out with the footprint charts and different ways to look at what is trading in the marketplace and basically putting the tape onto the screen in a way that is actually readable and consumable for a human being. And that would be basically a footprint chart. So if I flip over to this other chart book, you'll see here, for example, footprint chart that is for the E-mini S&P futures, and we can basically see the amount of volume that's traded at each price based on any kind of bar type that I select. In this case, it's a point and figure bar. Now, this is just another way to reference volume at price activity, and it is one trading tool that is used by a lot of different types of traders, day traders, to get a feel for the supply and the demand and the order flow going on in the marketplace. So in regards to futures trading, these tools originally came from futures trading platforms. They can be used to trade stocks as well with the addition of new and advanced data feeds. For example, Sierra Chart has come out with a new data feed for the NASDAQ Total View stock market. and I've been testing it so far. I don't believe it's totally completed yet, but maybe at the time you're watching this video, it is completed, and you should definitely check that out because I've noticed it to be a very high quality data feed compared to other data feeds I've tried. So better trade tools, absolutely available to futures traders. Now that's going to bring us to the next point of the video, which is regarding platform vendors and combine vendors. The industry of futures trading, I joke about this with my friends, but we say things like they need more souls. Platform vendors and combine vendors, they need more souls. They're always looking for new traders to promote their product to and say, try this traded evaluation and become a professional trader today by doing our evaluation, or advertising their trading platform in a way that makes it, a marketing deal and saying, this is the superior platform to look at order flow data in the marketplace. Well, I'll be honest with you guys, I fell into that in my trading career so far. And now I can see it from a different light. Now, the only reason I'm telling you this, guys, is because I know there's plenty of other traders out there who are just starting, or maybe you're experienced, and you're looking at different trading platforms and you're saying, which one can do this, which one can do that. And, I'm just going to be straight up honest with you guys. I've tried a few different ones. And at the end of the day, I just settled with Sierra Chart because Sierra Chart is known for being super reliable, and you can basically show the data on your screen in any single way possible that you can conceptualize in your brain. If you have an idea for how to display it on the chart ergonomically, or you just simply want a high performance data feed, then Sierra Chart's the answer. That's my opinion. You can try other things, but again, I'll take the word straight out of the developer of Sierra Chart's mouth. The majority of software out there today is no good. Sierra Chart, very good. Okay, one of the next cons regarding futures trading, and I would say trading in general, but more futures trading, it's that the markets tend to be heavily dominated by high frequency traders and the big firms that kind of control the inside bid and offer and what's going on there. The high frequency traders that have the potential to show an order of 1,000, trade a few, then pull the rest out. And because of the way the rules of the exchange are designed, that is perfectly legal because you're allowed to change your mind, right? I can submit a bid of 100 and pull it out right away if I wanted to. Now, if I was submitting bids of 100 constantly and pulling them out constantly, that's a little bit different, right? So depending on what you're doing, you can be categorized as spoofing. Now, certain times, what is happening in these markets could be considered spoofing, but it's not done enough on a certain frequency or that follows a certain pattern that can categorize it as spoofing. But it still happens, right? And there's no way around that because people are allowed to change their mind at any time. So the market is heavily dominated by high frequency traders. But the thing is, it doesn't mean it's untradeable. It's not untradeable, because there are traders that have business to be done every day, right? You have a few firms that come in and for whatever reason, they need to buy it. Now, if you as a discretionary trader have the ability to see what's going on in the marketplace, you have the ability to piggyback onto these traders that need to buy, you'll buy with them. Okay, if you have the ability to see what they're doing, you can follow the train, ride the wave with what's going on. The problem is now when the market is too slow and there's a lack of participation, now it becomes a lot harder for retail traders to do business because the people who kind of work the inside bid and ask, they can do whatever they want essentially. So, if they see, okay, I see a few traders coming in and taking my offer, what they do is they pull their bid out. And they continue to pull their bid because there's just a lack of participation and a lack of any new order flow that's going to be able to keep the price contained. So if there's a handful of firms that are there working on the inside bid and offer, they're all sort of seeing things the same way, and retail traders going to have a hard time making money when there's a lack of overall participation in the marketplace. So this relates to more trading strategy and knowing your environment, but I would say try not to trade in markets that have a low amount of participation. Just avoid them totally, right? And this could mean, the markets that you're used to trading. If you come one day and there's just nothing happening, just don't trade it. Look for something else. You have to go shopping sometimes. I like to look at a few different markets. I like to look at treasuries most of the time. I'll look at the E-mini futures if I find there's a good amount of liquidity. Try to find the best chart that's within my view, right? So for me, it's treasuries, E-mini, S&P. I'll look at crude oil. I'll look at currency futures like the euro and the yen. But just for reference, right? Every now and then, if I see a setup I really like, I might dip my toes in and trade one of those products. But at the end of the day, I'm mostly focused on treasuries and the E-minis. So again, guys, avoid markets when there's a lack of participation, because those HFTs are not going to give you the money you want. Okay, you want to be trading when there's a lot of participation, and I think this applies to stocks as well as futures. So I think, guys, we covered a number of the reasons as to why futures are good products to trade, and I'll kind of go over them again. One of them that I forgot was certain tax advantages, right? So depending on where you live, what state, what country, futures have a different tax treatment, and often it's more beneficial than other asset classes that you would look to trade. But I would recommend you to talk to a certified professional accountant for that, because it depends on where you live and whatnot. But I do know that they have a better tax treatment in the USA, and they also qualify for certain retirement accounts like IRA, etc. Okay, so let's go ahead and cover all the things that we mentioned in the video. So why futures are great to trade, why I trade futures: very good liquidity. Next thing is lower fees and lower capital requirements, but there's a catch, remember, regarding the day trade margins. The next thing would be there's a high amount of diversity in the participants that trade these markets. So you have all kinds of different people that look at these markets every day all around the entire world. Okay, so it's not just going to be you versus Goldman. There's all kinds of people looking at these markets at the same time, and that means there's a lot of opportunity going on. Now, regarding some of the cons with futures trading, there's a lot of different platforms and vendors out there that are trying to tell you why their platform or their service is the best one. And it just so happens that there's so much volatility. So this would be, I think, a 10-year bond auction that we just saw happen there in the treasuries. We're going off topic, but platform vendors, combine vendors, all trying to tell you why their service is the best one, guys. Another one of the cons here is regarding the heavy domination of high frequency traders in futures, which is absolutely true. So avoid them when there's no participation. You want to be trading when people are looking at the market and people are ready to play the game. People are ready to hit bids and hit offers and see what's going on, because in those environments, you're going to have an easier time getting quick entries and exits. And in a slow environment, when there's a lack of participation, there's a higher probability you get trapped in a trade and you have to get out at a price that is unfavorable. So that's it, guys. These are certain things that I thought would be helpful sharing with newer traders out there. Remember, none of this is a recommendation to trade, and I would honestly say don't trade unless you're willing to learn something, because every day that you trade, you have to approach it as a learning experience. If you guys like this content, check out other videos on the channel. I will catch you in the next one, and see you later. Take care.